Hello, I'm Tony Kaye. Welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, very good. Evan, let's start talking about iron ore. Interesting developments in the iron ore sector, particularly with stockpiles running down, the iron ore price holding up quite firmly at this stage. What's your view?
Yeah, it is interesting. I've been really positive and actually very bullish on iron ore for probably about 8 months now. What happened at the start of the year was very much the cyclical movement in iron ore prices that we've seen for the last 4 or 5 years, where you get Chinese Lunar New Year, there's a real fall away between March and probably the end of May, and then a really strong pickup. And that's exactly what happened, and we're currently going through that cycle. There was always a forecast that this year could be the start, and everybody forecast that the start of the hard landing, that China was going to slow down. The debt scenario around Beijing was going to hit there. It never sort of was coming to fruition from what you saw coming out of Beijing, and that's why I was really bullish on the back of iron ore, and we've seen that. And I think that needs to be very much
interesting. Atlas Iron has come out with its result, and that was a company that not that long ago was really close to the brink because of the fall in the iron ore price. Now they've reported a profit, which is quite a turnaround for them.
It is indeed. Again, and looking at the overall market, the one I always use is what Fortescue's done, because the reason for that is that the fact that they've really paid down debt. They have done everything on the operational side, on the levers that they can pull themselves, makes it very much a pure play in the idea that it is therefore completely exposed to the iron ore price in every way, because the actual operations are very slickly done, and therefore any improvement in the price is an improvement for FMG and vice versa. So that's the one I've always used. So it's a really good derivative idea around the iron ore price. But what's coming up and why I'm starting to move away from being really bullish to probably a bit more neutral is that I know that you and I have talked about this over the last couple of months, is around the Communist Party's conference, end of October, start of November. It still hasn't been announced on which date. It has to happen. It's part of the mandate of the Communist Party. And they have been bringing forward new startup projects. They've been bringing forward infrastructure projects, which is part of the reason why iron ore is absolutely on a tear and why those stockpiles are there. Then also the fact that everybody knows and have seen the Chinese really clamping down on environmental factors, and that means really dirty steel production. And steel prices were always making a loss. So they were making roughly around $28 a ton for every steel ton produced. And they had to really cut that out to turn it around. So you've had a fairly reasonable supply cut on the steel side, and that's been a positive for steel prices, why rebar is so positive, and therefore the demand for higher ferrous content iron ore also ramped up. So that's all real positive. But what is coming and what you can see, look at the Dalian futures, and that is now the active contract for January. It is making lower lows, and that shows that the cyclicality of the Chinese market is going to stay in 2018. And so I'm starting to move away from being really quite bullish to sort of a more neutral on a short-term basis. So once I look past November, past the PCP, iron ore is likely to flatten out. Come Chinese Lunar New Year, it'll be probably around sort of $70, and then it's going to fall away quite quickly. And that's all playing out right now, and you can see that in that futures contract.
Well, iron ore is just so important for Australia, the Australian economy. But getting into other areas, Jackson Hole, just major meeting of central bankers in Wyoming last week. What's your thoughts on that one?
Yeah, Jackson Hole. The Jackson Hole Symposium is always interesting because not only is it a meeting of the minds of all the central bankers, sometimes you do and sometimes you don't get some fairly large sort of changes in actual domestic macro policy. And we did get that. I wasn't expecting to get particularly from who we got, as much as we did. So Janet Yellen is clearly laying the groundwork that she doesn't believe she's going to hold on to her position, despite the fact that she's clearly done an incredible job. There's a political angle to it. And she laid out very clearly the strength of what they've done, the strength of the US economy is down to their monetary policy, and that they are in a good space, and that therefore is code for we will need to tighten, and we will. And that therefore, from my perspective, means that September is locked in for the balance sheet unwind, and probably around 10 bill a month on that one. That will start. We know they've been talking about it, but it really puts December of a possible rate rise in focus quite strongly. So means this Friday, non-farm payrolls, again, quite important. But that was really, really strong language from her. It's the most hawkish I'd ever heard her as well in terms of where they sit. So it was a real shot at Gary Cohen, the likely scenario, sort of successor to her, basically saying, you're going to want to walk in with a Trump agenda, which is a hugely dovish agenda of really spilling monetary policy out into the market again. We've been well managing it, and if you change it, you're going to have to deal with it. That was one side. Then Mario Draghi sort of was the other side. So the ECB has got highly unconventional monetary policy, and he reiterated what he said in Frankfurt sort of 5 days before, that they're going to start tightening up as well. So two major central banks. The euro did pop on the back of it. Interesting that the US dollar didn't move so much on Yellen, which is an interesting scenario. It means that the market's probably pricing all what she said in, but it was a confirmation from my perspective anyway that the largest and the second or third largest, depending on the Bank of Japan every now and again, are going to move rates and they are going to tighten. So that therefore is a bit of a headwind for equities, and it is something to be cognizant of. The interesting thing about it is that although that is under theory a headwind, if you have a look at what's happened in the last 3 tightening cycles for the US, equity markets have actually gone on a tear as well. So it may not be as much of a headwind as theory should suggest, but that is clearly what's going to happen before the end of the year.
Well, we'll certainly be keeping an eye on what happens with US rates and other rates around the world. And plus, there's a lot happening, as you know, between now and the end of the year in terms of elections in different countries, a lot of geopolitical tensions.
Yeah, so Europe is the one to watch. And so you've got Italy, and that's a big one. And the reason I say that is that, we know about what's been going on with Italian politics. Since you've seen Renzi go, it's been this another technocratical sort of government, and you've got Pepe Grillo, who's a very far-right nationalist idea. And having the third largest member of the European Union moving away to nationalistic ideas would be a real headwind. So despite the fact that he does want to tighten policy, he does have to deal with Italy, and they're also on the, bordering with the periphery countries, that if there was an instability in that country, that the issues, particularly in Portugal, Spain and Greece, would ramp up, considering the banking sort of spaghetti, I call it, excuse the pun, of the sort of the translation of capital between those countries. So if Italy was to really get messy, it would get very, very messy very quickly for those nations that I also announced. And they were back in the day when you had pigs. So taking Ireland out, the pigs would be coming on again, and that would be an interesting scenario leading into 2018.
Yeah, especially you've got the rise of nationalism and the rise of rates. What a combination that would be.
It would, and the rise of the idea, or at least the rise of the breakup of the European Union, continues to be mooted. It was suggested that France could be the catalyst with Marine Le Pen. Italy's the next one, and the other one that we don't talk about because it's quite stable is Germany, and Germany's the largest one and the one that realistically matters in all of this. So there is a growing sense that Angela Merkel won't possibly get her 5th term, and that would be very interesting to have a new German leader in the current environment that the European Union finds it in, not on a monetary policy side, but on a political side, and that national side, that very domestic focused sort of political populist movement, is a very interesting one to be negotiating in the current market.
Well, thanks again, Evan. Thanks for going over all that with us. Join us again for the Economic View next time.
InvestSMART Separately Managed Account Benefit number 3. Total transparency. In a separately managed account, you'll see all holdings, transactions, and income. Unlike a managed fund where you'll only be shown the top 10 holdings, or sometimes even less. You get to see the successes, and we won't hide the losers. With a simple click on the stock code, you can read the logic behind every buy and sell decision. For more information, visit www.investsmart.com.au or download our new app.